Charandeep Singh, founder and managing director, Girik Capital, and you've got Varun Daga, co-founder and fund manager with Girik Capital. Let's connect them to understand that how should one make sense in this entire market madness. Gentlemen, good morning. Thank you for joining us. Varun, make sense for our viewers. This entire banking crisis in US, what it means for India.
Hi, Nikunj. Thanks for inviting us. I think we've been hearing this for a long time and we'll probably repeat it. I think what has happened is, you've seen interest rates go up from 0% to 5, 6% in a span of 1 year, which is, of course, uh, probably never happened before. And I think we are seeing the brunt of it. And if you see globally, financials are probably the most overowned sector, and you have so many other opportunities on the debt side and fixed income side. So clearly, money is moving towards that, and you've had a decade of run in these financials globally, and especially India, and probably money is moving out from some of these overowned sectors to newer sectors and newer leaderships. So I think this is how market works. And usually, we've seen 18 months of correction in the market. The news is always bad towards the end. I'm not saying this is the end, but you've already been in an 18 months of corrective market. So you could see another, 6 months or so, and then you will see an emergence of new leadership. And we've seen year after year that's how markets work. You had 2 great years and then 2 bad years, and then again it'll come back with new winners, new performers. And as a fund manager or as an investor, you have to look at the brighter side. It's very easy to get lost in these news and bad news because there's always going to be bad news. But one needs to look for stocks and ideas where you can make money.
Sandeep, good news and good prices rarely comes together. So news is bad, but prices are not good or great. They're just about reasonable.
They're reasonable. I would say at a macro level, it appears like they are reasonable. They're not too cheap. They're not too expensive. But let's peel the onion back one level further. I would add to the point that Varun made. Look, you've had sectors that have done so well, where FIs have poured in money for so many years, like the financials, the IT sector, the consumer sectors. I mean, these are FI favorites, right? And this is where FI ownership is still at the maximum. And if they continue to sell, those are the sectors that will bear the brunt. So one has to be cautious maybe over there. But look, on the other side, what you have is a great opportunity, which we are very excited about, which is emerging in front of our faces, which is capex India, build India, manufacture in India. So many a confluence of so many factors coming together. Make in India, make away from China, diversification of global supply chains. And you have an Indian capex revival, which we've talked about and wanted for so many years, well and truly underway. Yes, this is compounded and made difficult by global headwinds, as we are seeing, high interest rates, FI selling in emerging markets. But this is how new cycles are born and new industries are born. So some of the most under-owned industries for so long may actually be your shining stars now. And I think that you're seeing, the beauty is that you're seeing reasonable valuations there with the emergence of an earnings cycle.
Chandeep, but if world slows down, which is what the general assumption is, whether it is because of liquidity issue or because of inflation, because central bankers are trying to storm growth, they are prioritizing inflation control over growth management, it will have an impact on global demand, which means that India's manufacturing renaissance, which was also hinging on the fact that we will emerge as an exporting country in manufacturing goods, that also gets delayed or challenged.
No, you're not wrong, but I don't agree with one thing is that, once a trend is secular and the wheels are in motion, these are not decisions that one says, oh, now, we've got demand slowdown, so they're going to stop. These are strategic decisions. To put up a plant, you may delay it by a year, a little bit, and if you're in the middle of a crisis. But these are very strategic and long-term decisions. So we are talking about a very long-term trend here. In the near term, you could have blips. Also, don't forget, right, when you're talking about diversifying away from China and creating stability in your supply chains, it's not going to happen overnight. putting up plants, rolling out capacity, entering into contracts, that takes years. But the wheels are well in motion and we see it. And I'll tell you, this has a cascading effect on many suppliers, many vendors, many small companies supplying components, ancillary companies, and you're already starting to see it. So I do take your point that there could be blips and delays, but the trend is very secular and we see the opportunity over there today.
Hi, morning. Earlier, we were interacting with an expert who said that it would be unreasonable of sorts to compare the kind of route that we're seeing in markets overseas, or rather in banks overseas, to what's happening back home. What would be your take on, the overall Indian banking system, given that it's awfully vast as well with large private PSUs, NBFC, even if we were to look at the insurance space? So how would you believe investors should really tackle this sector?
I'm happy to take that question.
Sure, Charandeep, go for it.
Look, there's no comparison between our system and theirs. They're a very democratic, open system, which is, also a super bankruptcy regime. Now, of course, when a large bank like this, something like this happens overnight, you have to have the panache, the suave, and the ability to move very quickly. In India, our regulators are so conservative that, it's very hard for us to even reach there. Everything is so regulated. That being said, look, there are indirect impacts which you cannot ignore. When interest rates go from 0 to 5% in 1 year or thereabouts, when bond yields in the West and in emerging markets are ranging anywhere from investment grade 5.5% to 8, 9, 10%, you have a lot of alternatives internationally as an investor. Right? Today, if you were an equity investor on the margin, or if you were a hedge fund who was borrowing at very low rates, everybody's switching priorities. You have to be very careful about borrowing money at high rates. You also have to be very careful of deploying money in equities. So a lot of money that in the margin was coming into equities, those flows are constantly being challenged. And India has seen those outflows now for a while, may continue to for some more time. So there are huge indirect impacts of this. I think what you saw in SVB is a very direct impact of rising interest rates. But I think most emerging markets will suffer from this nature of outflows. We're very lucky that we have a large now pool of domestic savers via pension and SIPs who have been able to take the brunt of this buying, well, at least in the large cap space. Take the brunt of the selling from FIs in the large cap space largely.
I remind our viewers that today we are not discussing COVID, we are not discussing war, we are not discussing, there's a time when European countries were named as pigs. Forget banks defaulting, countries are about to default, but we are not discussing that today. And that is because markets move on. Today the center of the storm is SVP. 3 weeks ago it was Adani. And guess what? In this market sell-off, Adani stocks have not fallen. So that is on markets for you. What looks big today is going to be small. And that what is small today may actually look big. So Varun, what are you telling your clients now in terms of next 3 to 5 year, if somebody is investing with you? You are a boutique PMS scheme, which is that you've got a combination of mid and large cap stocks. You like to bet on mid cap stocks, which can become large cap stocks, and small cap stocks, which can become mid cap stocks. How are you choosing, where are you choosing your spots?
Yeah, so, Nikunj, we are clearly telling our clients that, we've seen a great consolidation for 1.5 years. You could see another 6 months of pain. That's very possible. We'll be very happy if that happens, because every time you have a correction, it just gives you greater opportunities to invest. Also, we always tell our clients to, at least take a 5-year view, because you'll always see markets, not do well for 2 years, and then you'll have a couple of good years. So I would say that for any investor, if they're investing in equities, if they're taking anything less than a 5-year view, things may not be as they would have thought. But once they take a 5-year view, I'm sure they will at least catch one cycle and they will see how rewarding equity investing can be. That's on the time frame. The other thing is that, what Charandeep said, that, every bull market, you have new leaders that emerge. And we are seeing this emergence into industrials, into cap goods, and anything that helps build the country. What is exciting is that many of these companies have not even been researched for the last decade. and most analysts on the street don't know how to evaluate these companies. So I think that's where the excitement is today. And when we look at them, we really don't know when the upcycle comes, what will happen to their margins. And, one could really get surprised by the size of the opportunity and the size and the profit pools out there. So I think that's where we are doing our work because, on the other side, which is financials and uh, IT and consumer, they are very, very overowned. And at the same time, there are too many people out there. Like if you look at 5 years ago, you had three places to invest in. You were investing in Kotak, HDFC Bank, and maybe ICICI, maybe one, two more, maybe Bajaj Finance. But today you have the private sector banks, you have the PSUs, small finance bank, microfinance, the fintechs are lending. I mean, everybody wants to lend money. And usually, when there's too many people doing the same thing, from an equity market point of view, it's harder to make money. We saw that in the real estate, from 2007 to now, people hardly made money in that sector when everybody wanted to become a builder. So I think the idea is to be in places where things are under-owned and try to find value there.
In places that are under-owned. So either of you can take this. Let's just talk about some of the key portfolio holdings as well. Names like Sirma SGS, for example. It's not even been a year, but been awfully quiet over the last 6 months or so. What's the overall rationale for betting on that one? And then there's that PSU tilt with the likes of NTPC and REC. Walk us through the rationale here.
I'm happy to talk about NTPC and REC a little bit. So we've been in there for some time, especially with NTPC. And please, I just like to warn viewers not to construe this as advice because these are our thoughts and they're very subject to change quickly. So one must take that, a worthy note of that. NTPC, we got into it almost a year ago, thinking that this whole theme of capex revival, and we saw very stable earnings and a reasonable dividend yield, and we thought that the earnings would become much more structural, the growth would be much more structural, and it was again very under-owned by the street, and we felt we were very early there. It's now kind of starting to reward us because the price has not really moved that much, but we still feel there's a huge scope for re-rating potentially over time. REC is a little similar. It's a little bit linked to the power sector because traditionally been a lender there, but they have more avenues open. Extremely inexpensive, under-owned, unloved, and not researched. And I think that such an extreme, the profit pool there is similar to Bajaj Finance's. The market cap is 15% of Bajaj Finance, or 10% or something of that order. So I think there's anomalies in the market that we're trying to capture. And I think where we see stable growth and very predictable growth, but not many people modeling it, it's something that we like. On Sirma, maybe Varun can talk about a little.
Sure. So again, I think we thought it is a good management, very well-run company, and the size of the opportunity is very big. As we are manufacturing more and more into India, as people are moving away from China, we're really seeing a big opportunity in this entire sector. So let's see how it plays out, but it's extremely exciting what can happen over the next decade in this sector.
Okay. Charandeep, the fact that let's say what the declared holding at least I have, I can only see Axis Bank. Now the benchmark indices are approximately have a 35% weightage in financials. You've decided to go easy on them. If any country has to do well, financials have to do well. I mean, it is always a multiplier on the economy. Any specific reason why I cannot see a lot of banks in your portfolio? Or am I missing them?
I mean, Nikunj, that's true and not true, because if you looked at the whole bull run from 01 to 08, financials were not this large. Financials have only become large after 18, 19, 20. They went as high as 42% of the index, if I'm not mistaken. And now they've been losing share. I believe from 42, they came off to 36 or 37. So I'm not sure I agree with that. I think that, ultimately winners stay and the rest fall away. And that's the beauty of an index is built up. An index always performs over time because it's simply picking winners and adding its heft in the winners. So if these stocks don't perform and Larsen and Toubro performs, its weight will go up. Also let's not forget that these stocks have had a very large free float, which is why also they have such a large, weightage in the index. So I'm of the view that these sectoral shifts, we are of the view rather that these sectoral shifts, tectonic shifts take long time to play out. HDFC Bank was 2% of the index in Jan 08. It's now with HDFC merger, it'll be like 14% I'm told. So I think things, move in cycles, and we're a big believer that a reverse of the cycle will happen now.
Okay, fair enough. What about the outlook on autos, Varun? Do you believe that some of the concerns now are behind when it comes to, volume growth, acceleration in inflation, perhaps even the chip shortage?
Yeah, so at least so we had this period of COVID where the demand went away, and you had chip shortages and inflation, and I think a lot of that is cooling off. So hopefully, it's all reversing, and that should help the sector.
Okay. What happens to IT, gentlemen, now? Because if we are at a slowdown or a recession, a large sector like IT, which in a sense is India's gateway to glory, will slow down. The aggregate earnings will get impacted. And if aggregate numbers get impacted, brokerages will come out and say, "Ar India premium पे चल रहा है, discount में नहीं है, we are trading at a 50% premium to other emerging markets, valuations are higher than historical averages." All that, sum and summary will start again. So what happens to the aggregate earnings picture in this kind of an environment?
Yeah, so I think that's a good question because after COVID, we saw everybody was rushing towards the IT sector, and then the earnings stalled a bit or stopped growing as fast as it was, and then the derating started. So I think one thing is very clear that the re-rating and derating always moves with the acceleration and deceleration of earnings. So I think that is one thing one should always remember whenever there's earnings acceleration in any sector, you will see multiples get re-rated and it plays the other way around. That's why you see stocks go up 5x and they also fall 50%. But the earnings actually don't move in that that fashion. So you saw that with IT, but they are great companies, generate a lot of free cash, and they've been amazing companies. And look at the size they've reached. They have really put themselves on the map globally. So I'm sure they will continue to do well. You might see valuation come off here and there, and probably that's when opportunities will emerge. But as of now, I would say that there is a bit of a headwind out there.
Okay. All right, gentlemen. Really appreciate your time. Thank you for joining us. The good news today is that we've appreciated by nearly 0.5%. We are making a recovery. It's not like a very meaningful or a V-shaped recovery, but like they say that this shall also pass. 2 weeks ago, it was all about Adani and impact Adani group of stocks could have won the Indian lenders. Today, it's all about global lenders and US banks and what they will do to the world.